Today, I'm going to show you 4 dividend stocks undervalued and poised for a breakout. I'm Jonathan, and we're going to start right now. In a sector full of overvalued stocks, HP Incorporated, ticker symbol HPQ, provides a breath of fresh air within the IT industry. To put it like Warren Buffett, HP is a great company at a great price and possesses the capability to provide investors with potential long-term total returns greater than 15%. The company has a market cap of $40 billion and provides personal computing devices, imaging and printing products, and related technologies in the United States and internationally. HP currently has a yield of 2.73% with a 5-year dividend growth rate of 10.5%. They increased the payout by 15% in the previous year, and analysts estimate that they'll raise it another 13 to 17% in 2022. Their payout ratio clearly supports the ability to keep up with the increases, sitting at just over 25%, even after 11 consecutive years of raising dividends. In the company's fourth quarter earnings call, CFO Marie Myers said, "Looking ahead to fiscal year 22, we expect to continue aggressively buying back shares at elevated levels of at least $4 billion. Our share repurchase program, combined with our recently increased annual dividend of $1 per share, has us on track to exceed our $16 billion return of capital target set in our value creation plan." HP pays dividends quarterly, with the next payment coming in April of 2022. HPQ currently sits at $37.14 a share and is within 6% of its 52-week high. But that doesn't concern me too much right now. This stock seems to be massively undervalued, even though it's soundly beaten the total returns of the S&P 500 over the past 5 years. EPS for HP is an impressive 5.33, considering its previous high over the last 5 years sits at around $3.20, signaling that it's primed for a jump, and that's not even considering its PE ratio of 8.77, which is extremely low for anything in the tech sector right now. Take a closer look if you haven't already. Moving on to the utilities industry, let's dig into my number one electric utilities dividend stock, NRG. They're a retail energy provider with a $10 billion market cap that is undervalued largely because they're transitioning into a new space with a relatively untested concept and a large amount of debt. So they're not without their risks, but if their concept pans out, they can be had for a bargain at under $40. Unlike some energy suppliers which only produce energy, or some energy retailers who only purchase energy wholesale and sell it to customers, NRG is fully integrated in some markets. This means they both produce energy and sell it directly to consumers, which relieves them of the need to participate in wholesale energy markets. Investors willing to take on some risk could be rewarded, as they're market leaders in the retail energy space and are committed to share buybacks and dividend increases. NRG has a market-beating yield of 3.26%, with a crazy 5-year dividend growth rate of 40%, propped up by a 900% increase in 2020. But even last year offered a respectable 8.3% increase. Analysts expect to see something similar to that number in 2022, and I don't see any obvious reason they would be wrong, especially considering the safe payout ratio of 34% as of the last report. In terms of share repurchases, CEO Mauricio Gutierrez recently stated that they're anticipating lighter investment and growth in 2022, and that would result in higher return of capital than the 50% the company indicated earlier when compared to 2023, 4, and 5. It pays dividends quarterly, with the next payment coming sometime in February, so make sure to get in before the ex-dividend date later in January if it's something you're interested in. NRG currently sits at $39.75 a share and is 14% off its 52-week high, which it reached in September of last year. It's consistently outperformed the S&P 500 and the market in general during the last 5 years, so it has great growth to go with its dividends. EPS for NRG is 9.98 and quickly approaching its high after taking a pretty big hit in 2020, as much of the energy sector did. The turn to its new business model does present risk, as I mentioned before, but if you're not totally risk averse, its past history suggests that the management team should keep it on a similar, if not more aggressive growth path. Now, let's ease over into the industrial sector with a solid dividend stock from the trucking industry, Ryder System Incorporated, ticker symbol R. Ryder's considered at its core a logistics and transportation company. Currently, the company operates 800 plus facilities, manages more more than 250,000 vehicles and employs the services of over 9,500 professional drivers. It operates primarily across the United States, Mexico, and Canada. With a market cap of just over $4 billion, the vast network that this mid-cap company maintains is the key factor for future growth in an industry that's expected to expand as demands for goods, e-commerce, and customizable customer solutions increase and global supply situations recover. Ryder boasts a 3% yield and a 5-year dividend growth rate of 6.05%, although the most recent increase was only around 1.8%. Analysts expect to see something similar to that number in 2022 and higher increases in the following years. This is definitely a longer-term play in my opinion, so that is something to consider when making your decision. Seeking Alpha gives Ryder a B+ grade on dividend safety and an A- on dividend consistency, suggesting that investors are unlikely to encounter trouble down the road regarding the company's income distributions. The payout ratio for Ryder stands at 27%, further indicating the company's ability to continue payments with no issue and leaving plenty of room for improvement. It pays its dividends quarterly, with the next payment coming sometime in March of 2022. Ryder's share price is $77.80 and is 16.5% below its 52-week high of $93 back in October of last year. Its 5-year total return sits at just 23.5%, so that's another thing to take into consideration. EPS for Ryder is 6.84 and rising, but is still far from its 2018 mark of around 15. I'm not sure it's a fast track to get back to that range, to be honest, but share buybacks and continued revenue growth as the industry progresses throughout this year should keep it on an upward trajectory. Our final stock comes from the financial section and is one of the ones I'm most excited about right now. Fidelity National Financial, ticker FNF, is one of the biggest companies in the housing market that few investors recognize. This creates an opportunity as they're involved in nearly 1/3 of all home purchases and refinances in the United States. As the housing market is expected to remain hot for quite a while, Fidelity National should continue to see large growth in their business. And while rising rates may cool the activity in the housing market by a few degrees, the company's annuity and life insurance division should thrive in this environment. Even with a strong stock performance for 2021, Fidelity National Financial is still in a great position to continue that growth. This creates a good opportunity for investors to buy a great company today. FNF has a current yield of 3.34% with a massive 5-year dividend growth rate of 19.7%, including last year's increase of 15.5%. Analyst estimates put their 2022 increase somewhere in the range of 14% as well, maintaining their great dividend growth over the last 7 years. Their payout ratio comes in at just under 24%, leaving plenty of room for continued growth. Fidelity National Financial's management team has built a steady, conservative business that's managed to grow and succeed despite hardships in the United States and globally during their 170 years of business. Thanks to the nature of how the company is run, as well as being well positioned for the demographic change, the pandemic has been a successful period for the company. This has benefited shareholders in not just share price appreciation, but also rapid dividend growth, as you can see. Fidelity National pays dividends quarterly, with the next payment expected in late March of 2022. FNF's share price of $51.14 is almost 10% off of its 52-week high of only a week ago, but indicators show that the share price still has room to grow. Its continued upward trajectory accounts for a 1-year price increase of 37% and 149% over 5 years, beating the market and the S&P 500 with ease. EPS is an impressive 9.27 and on a blazing path upward over the last 5 years. The best part is there's no sign of a slowdown. When we look at FNF's valuation framework on Seeking Alpha, we see straight A's across all of its valuation metrics. With continued strength from title insurance, real estate, and mortgage industries, FNF still comes at a great discount even with its recent pricing and is worth considering in portfolios. If you got any value from today's video, I'd appreciate it if you pop that like button and subscribe. I mean, we've been hanging out this long already, right? Thanks for sticking it out with me until the end today. See you next time.